It was a more challenging environment for Australian small caps this reporting season, particularly when you compare it to the larger end of the market. And it was almost a reversal of the positive outlook that we saw at the previous reporting period for Australian small caps. So what drove that? First of all was on the macro side. Interest rate increases at the beginning of the month negatively impacted the smaller end of the market more than the larger end. Key reason for that is because of the higher consumer discretionary exposure at the smaller end of the market, as well as banks, which is largely a larger cap phenomenon, representing about 40% of the large end of the market, are typically beneficiaries. Also, the banks surprisingly delivered exceptionally strong results. Revenues were better, costs in line, bad debt provisions were better than market expectations, seeing EPS upgrades for those companies and strong share price performance where the smaller ends of the market didn't participate. Secondly is looking at the industry factors. The most notable is the AI fears on the information technology space, particularly those SaaS businesses that are overrepresented at the smaller end of the market relative to large caps. There's a market narrative that many of these new AI agent tools are going to displace some of the workflow solutions that these companies generate. Although interestingly, this reporting season, we saw the complete opposite transpire. Many of the companies like the Hansen Technologies, Iris, Bravura, saw cost efficiencies coming through and margin expansion, which fell to the bottom line, which benefited shareholders. The big question is whether or not the AI narrative is real or overblown by the market. Here at MBA, what we are looking for is those companies that are providing mission-critical software for their clients, are embedded and are hard to displace. Earnings drove share prices this reporting season, which is typically what we see during most reporting seasons and is aligned to our earnings drive share prices philosophy that we employ here at Maple-Brown Abbott. If you look at the market in totality, earnings upgrades were broadly in line with downgrades with a slight skew to the downside. If you look at those companies that performed poorly, it was driven by more stock-specific factors rather than any underlying cyclical factors. Some notable examples include the likes of Bapcor, G8 Education, and Helios, but they were more stock-specific factors coming through. One of the sectors that did surprise on the downside was the retail sector. First half 26 sales numbers were broadly in line with market expectations, although GP margins were below. Key reason for that was due to higher promotional activity to activate the consumer. Interestingly, the trading updates that were provided by many retailers for both January and February were below market expectations, which did disappoint market expectations. However, the expectations of a higher Australian dollar will give retailers benefit into second half of 26 and more so into FY27 as the hedges roll off and they're beneficiaries of being a net importer. On the flip side, those companies that surprised on the upside saw more muted share price reactions despite delivering positive results. Some of the notable areas of sectors or industries that delivered positive EPS upgrades include the likes of mining services and contractor companies. These are positively exposed to mining CapEx as well as infrastructure CapEx. Information technology companies also delivered reasonable results, although weren't rewarded from a shareholder perspective given the AI themes, particularly on SaaS businesses. Also, what we saw is select investment managers delivering good results, particularly those that have been able to navigate the highly volatile investment markets that we've seen. One of the areas of interest during this reporting season is whether or not New Zealand is finally seeing green shoots emerging. It's taken a while for the RBNZ interest rate cuts to eventually flow through to the New Zealand economy. In August of 2024, they were 5.5%. Now they've been reduced to 2.25%. But given the roll-off of fixed interest rates in the New Zealand market, that transmission mechanism is starting to come through in the calendar year 2026. We were positively surprised by some of the positive trading announcements by some of the New Zealand retailers, JB Hi-Fi, Kathmandu, Baby Bunting via the New Zealand exposures saw a reasonable step up in like-for-like or comparable sales growth coming through for their stores. Even Michael Hill Jewellers, a discretionary part of the market, has actually seen a reversal in their like-for-like sales growth coming through there. The big question is whether or not retail is the canary in the coal mine for the rest of the New Zealand economy. We are yet to see that flow through into building construction and civil activity there, but that is expected to come through in 2027. Going forward, we remain constructive at the smaller end of the Australian equity markets. You just have to look at the EPS growth that is expected to come from the smaller end of the market versus the larger end of the market for the rest of the financial year 26 as well as into 27. And the smaller end looks to be offering superior earnings growth versus that of the larger end of the market there. One of the key drivers of that is the small resources exposure, which now represents over a third of the small end of the market, and half of that is gold related, and the remaining exposures is highly leveraged to the electrification and decarbonisation themes, which are positive. Also on the valuation side is Australian small caps are trading at a discount versus their long-term average, and at about a 15 to 20% discount relative to large caps. And given that superior earnings growth, we remain constructive going forward at the smaller end of the market.